Good afternoon. My name is Kent Skornia, President and CEO of Krilogy, and this is my partner, John McArthur, Chief Investment Officer here at Krilogy. And this is your March market perspective. Thanks for joining us. John, wow. It's been, 4 weeks since we sat down here in this exact same spot, given our perspective in February, and lots changed. A lot of happenings in the financial markets. You would think the news outlets, this is like heyday for them, right? I mean, talk about amplification of the news. I mean,
minute by minute changes.
Yeah, this is Super Bowl time for them. Feels like. What's your thoughts? What's your team saying? What's your perspective on what's happening in the financial markets right now?
Yeah, well, we've, as you indicated, there's plenty going on in every aspect in the financial markets, and specifically centered around the banking industry. We've seen just a ton of change. I think it's important for investors to recognize the recency bias from '08. I think it's very human nature to associate this period with 2008, and I think that's really key to distinguish the differences. I mean, 2008 was characterized by toxic assets and over-levered, under-capitalized balance sheets. That's not what we're talking about today. If we look at Silicon Valley Bank, really where the kind of the first scarring and evidence, if you will, from the Fed's historic rate increases over the last 12 months or so, that was really about a mismanagement of duration in their investment portfolio. I mean, this summer of 2020, short-term capital earned you zero. The 10-year Treasury earned you 50 basis points. And so, that particular segment of their business, not to get too far into the weeds there, but was growing incredibly. So they came into all of this money and all of these assets, and they took irresponsible risk, and their investment portfolio had a duration of 5.6, and the increase of rates and the Fed rate hikes and so forth just caught them offsides.
And they're the overconcentration in a lending and deposit group that can sometimes create cash crunches for their companies they're serving. And
that's right.
The tech space is a highly cash intensive space. And that's what happened, right?
Very niche. I mean, we're in a crisis of confidence more than a banking crisis, for sure. Now, that's not to suggest that it can't become a self-fulfilling prophecy and have some significant spillover effects. I mean, we've seen it in recent days. Signature Bank and Credit Suisse this past weekend.
That's where the amplification comes in.
That's right.
And the fears amplify more fears.
Yeah, that's right.
Regardless of fundamentals sometimes.
That's right. I think what's, in a kind of a strange way, this environment that we're in, having gone from kind of hard landing expectations, deep recession, to the S&P starting the year up 8% in January roughly, and the conversation shifting to all clear almost in some respects, and the no landing financial media conversation to deep recession crisis type concerns again. It's been really volatile, of course, but I think the silver lining, I mean, you look at a week like last week, the S&P 500 was up marginally, up 1.4%. We're going to see, as a result of this, we're going to see slower credit and loan growth. We're going to see an increased cost of capital. Banks are going to tighten up. I mean, in a strange way.
I mean, the Fed's got to be sitting there going, that's good.
It's not bad.
You're going to hit our disinflation goal, right?
Strangely, this process could be getting the Fed out of the way when just several weeks ago, if even, Chairman Powell was kind of greasing the expectation of a 50 basis point hike this week, and then a few more. And again, the disinflationary or even deflationary impulse from this is likely to occur, and demand destruction, which is what the Fed is after, will likely happen. So in a strange way, if we can look out beyond this period for the markets, this hawkish policy that's been in place for a while could be wrapping up much quicker than expected.
I think it's interesting your talk on recency bias, right? And 2008 and 2009, I think we all remember what it felt like when the entire financial system was on a shaky foundation, really, until the Feds stepped in and the federal government stepped in. But I can remember this because we started Krilogy in December of 2008.
Yeah.
And what most people forget is that the market bottomed out 10 weeks into 2009.
Right.
Although the fears were probably at their peak,
Right.
somewhere around there.
Right.
So, that fear piece doesn't always tie into the actual market piece in terms of the returns.
It's a great point. I mean, the kind of the shift from denial to kind of panic, which is really where we're at, really characterizes a bottoming process. I mean, if you think about when this market actually peaked, for the S&P, it was January of 22.
Yep.
For the NASDAQ, it was November,
Right.
mid-November. So we're 16 months into this, and pre-election years, you have to take this with a grain of salt, but if we look at your typical pre-election year, this is the strongest period or year for the market in a presidential cycle. Average return since 1922 is 13.6% in a pre-election year, compared to election and post-election years are about 7.5% roughly.
Right.
And then midterm years are about 3.5% annually. So, and that doesn't even count coming off of a really bad negative year for both the stock and bond market. So, again, you have to take that with a grain of salt, but it's important to recognize kind of the emotional and sentiment consensus that is really at the forefront. And, as the saying goes, typically when everyone's aligned with similar thinking, something else happens. And it's hard to find many that can paint much of a bullish picture in this backdrop.
Not a lot of greed in this market at the moment.
No, not at all.
Okay,
No,
so
not at all.
market, stock prices are a reflection of earnings.
Yeah.
And talk to us about where earnings are, what's happening.
Yeah, well, we've already come off, at least 12% from, going back to the middle of 22. The expectation for 2023 S&P earnings was nearly $250. I mean, we're at maybe $218 in expectations. So we've kind of seen this slow downgrade in earnings revisions and expectations. And so, if you look at market pricing and future market returns, a weak earnings environment is really a good recipe for future returns. It's the extremes that are not so favorable.
Right.
So good earnings environments, somewhat counterintuitively, aren't a great backdrop for future market performance. And conversely, when we are in a really negative, sharp earnings decline, there tends to be more work to be done. And there just isn't evidence of that yet.
Right.
One could assume if this banking situation in this crisis of confidence kind of snowballs into something much larger, which is possible but not probable in our opinion at this point. It feels more idiosyncratic than a system-wide issue at this point.
Yeah.
Then the backdrop is favorable.
Right, and
some
if they start to
respects.
dramatically, revise earnings to a really extreme level, now it's the old, catch a falling knife.
Yeah,
People
right.
People are really nervous, hard to get a bid.
Exactly.
So-
That's
so
a
to speak.
cascading effect at that point. Yeah.
And there's risk, right? We're not sitting here, and I think it's interesting as business owners and as market participants, we're bullish sort of by nature,
Right.
mainly because we believe in America.
Yeah.
But number two, though, as portfolio managers,
Mhm.
you tend to be, and we do as a whole at Krilogy, tend to be sort of conservative by nature.
Right. Yeah, that's exactly right.
And so walk us through what's happening in the portfolios today and what you're seeing.
Yeah, and so if we look at the bond market to kind of piggyback off that, the 2-year Treasury, the volatility in the bond market, first of all, hasn't been this volatile since 2009.
Yeah.
The 2-year Treasury in the course of 7 or 8 days went from over 5% to about 3.8%.
It's a huge move.
I mean, 125 basis points
Huge.
roughly.
Yeah.
That's historic. So we're seeing the rate complex in terms of yield come down significantly on, a pricing in of a crisis or hard landing,
harder,
recession type of backdrop.
Yeah.
And, we had lengthened duration in our portfolios a couple weeks ago, which has helped because again, as yields go down, bond prices go up. So as you lengthen quality and duration, that helps when yields go down. So the good news is that peak yields are behind us. I mean, we feel very convicted in the 10-year Treasury peaking at around 4.25. That's behind us. And so
other interesting note is that the market dropped, right? And the bond market actually buoyed our portfolios, which last year in all portfolios out there, that didn't happen. Both the stock and the bond market dropped simultaneously, which actually hurt a lot of returns.
You're right. We've shifted from this inflationary concern, which is what hurt bonds last year, to getting beyond that and looking ahead to, oh gosh, there's an economic calamity or crisis or recession of some magnitude on the horizon. So investors can truly expect more negatively correlated benefits from their bond portfolios, which we didn't get, you're right, last year.
Which we didn't get last year. So not to get too far into this episode, but give us your 3 takeaways that you have going on right now.
I think just being mindful of recency bias. I mean, 2008 is very fresh in folks' minds that have been investing in the markets for some time. This environment is different than that. Banks are healthier by and large than that period. This is more of an interest rate risk type of environment. So just mindfulness of the behavioral impacts that can influence investment decision making if we let it. I think another indication that I would suggest is that the pre-election period, you can't fully dismiss it. Positive 84% of the time going back to 1922. Those are favorable odds. Again,
it's a stat hard to ignore.
We're sifting through the thick of it right now. And then just sticking, as we tend to always say, just stick to your process in the portfolio that you've worked with your advisor with in constructing, and some tweaks around the edges as we go definitely can make some sense, but sticking to the core process is really important for long-term success.
That's great. Thank you, John. I appreciate it. And thank you all for the opportunity to be stewards of your wealth and your finances. And as we hop in here in the spring, we wish you nothing but the best as you start off your spring season here. And with that, for John McArthur, I'm Kent Skornia with Krilogy and your March market perspective. Thank you very much and have a great day.
Thank you.